Hey everyone, it is Julie here with TipRanks, and today we're taking a look at 3 under-the-radar growth stocks. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at 3 under-the-radar stocks that all come in with a strong buy consensus and some pretty bullish price targets from analysts. So today we're going to take a look at these companies, what it is that they do, and what those analysts are predicting for the stock's future. Just before we get into that, this is your reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. You can also download the TipRanks mobile app to stay up to date with all the latest investment news and access your favorite research tools on the go. Links will be in the description down below. Now let's get right into our 3 growth stocks. First on our list today is a company called Leonardo DRS. Their stock trades under the ticker DRS, currently priced at $21.29 per share. In the past year, the stock has climbed 44% and has grown 8.7% in the last 3 months. They do currently score a 10 out of 10 on the TipRanks Smart Score. This is a company with a 50-year history of success in the defense industry. They are a prime contractor, leading technology innovator, and supplier of integrated products, services, and support to military forces, intelligence agencies, and defense contractors worldwide. They operate in 2 main segments of advanced sensing and computing and integrated mission systems. They have important contracts, such as ones with the U.S. Army, to provide advanced thermal weapon sights and forward-looking infrared sighting systems, and the U.S. Navy, for which they're providing propulsion equipment for their new submarines. They'll be sharing their Q1 earnings report in just a few days on May 1st, and this does follow an earnings beat for their 4th quarter back in February. For their Q1, analysts are anticipating earnings per share of 12 cents, which would be a 5-cent increase over last year. This follows their 4th quarter, where they reported earnings of 31 cents per share, beating expectations. The company saw $926 million revenue for the 4th quarter and $2.8 billion for the year. They also had a new company record of $7.8 billion in backlog. That was up 82% from the prior year. Last month, we had a 5-star analyst from Bank of America reiterate their buy rating on the stock. They said that their confidence is anchored in the company's clear vision for growth and strategic capital deployment, as well as their focus on mergers and acquisitions that promise to be immediately accretive. The company's approach to developing platform-agnostic technologies enables them to tap into a variety of international and adjacent market opportunities, thereby widening their potential for growth. With 5 current analyst ratings, the Leonardo stock does come in as a strong buy with 4 buy ratings and 1 hold. The average price target comes in at $44.75, which would be a whopping upside potential of 110%. We can see on the right here that is because we have one very high outlier. Looking at our recent price targets, they range from 12 to 22%, and then we have this one very bullish price target from Goldman Sachs. For our 2nd growth stock, we're moving to the biopharma industry with Catalyst Pharma. They trade under the ticker CPRX, currently priced just shy of $15 per share. Now you can see the stock has had a lot of ups and downs this past year, and overall is down 8%. It has climbed 9% in the last 6 months and 3% in the last 3. They do currently score an 8 out of 10 on the TipRanks Smart Score. Catalyst Pharma is focused on developing new treatments for rare diseases. They focus on rare, debilitating chronic neuromuscular and neurological diseases, and these can be very difficult to treat with small patient bases and life-threatening effects. But Catalyst has overcome those challenges and does have several approved products on the market for a variety of conditions. Their drug amifampridine is the only evidence-based FDA-approved treatment for adult patients with Lambert-Eaton myasthenic syndrome, or LEMS. They also have license rights for Fycompa, which they acquired in January of last year. This is the only AMPA receptor antagonist epilepsy treatment on the market. Catalyst will be sharing their Q1 earnings report in a couple of weeks on May 8th. This follows their 4th quarter, where they not only had an earnings beat, but also reported record revenue. For their Q1, analysts will be anticipating earnings per share of 20 cents. In their Q4, they reported earnings of 31 cents per share, beating expectations by 4 cents. They achieved record 4th quarter revenue of $110.6 million, which increased 82%. And looking at the full year, they also had record revenue of $398.2, increasing nearly 86%. The company gave full year total revenue guidance of $455 to $475 million. Last month, one analyst from Citi initiated coverage on the Catalyst Pharma stock. They gave the stock a buy rating and said that their flagship product has the potential to achieve peak sales of $500 million in the ultra-rare indication of LEMS syndrome. They said that the company has built a robust patient-finding network that has steadily converted a portion of identified patients onto the drug, providing consistent revenue growth. With 7 current analyst ratings, the Catalyst Pharma stock does come in as a unanimous strong buy. The average price target comes in at above $25 per share for an upside potential of 72%, and we don't have any extreme outliers on this one. Looking at our price targets down below, on the low end we have a buy rating from back in February with a slight downside of 1%, and a $34 price target here from Cantor Fitzgerald for an upside of 130%. If you've made it all the way to our third stock today, this is your reminder to make sure you hit that thumbs up button. Third on the list, we're taking a look at ZTO Express. They trade under the ticker ZTO, currently priced at $21.21 per share. Now, the stock did have a rough go at the end of 2023 and is down about 23% in the past year, but has been climbing back recently, gaining over 24% in the last 3 months. They do currently score a 9 out of 10 on the TipRanks Smart Score. ZTO is a China-based express delivery service company. They have taken advantage of the fast-growing digital merchandising sector in China. Since their start in 2002, they've expanded their market share in parcel delivery to more than 20%. They've been partnering up with some of China's major online retail sites, including Alibaba and JD.com. They'll be sharing their Q1 earnings report in mid-May on the 15th. For their first quarter, analysts will be anticipating earnings per share of 33 cents, and if we look down below, that's fairly in line with last year's. For their fourth quarter, they did report earnings per share of 37 cents, which was in line with expectations. Their full-year adjusted net income grew over 32% to 9 billion RMB, and they increased their annual dividend 68%. Just a couple of weeks ago, we did have an analyst from Jefferies weigh in on the ZTO stock. He does rate the stock a buy, highlighting the company's ongoing commitment to diversifying products, reducing delivery times, and refining customer service and last-mile delivery operations. He said that the company's share repurchase and dividend actions signal confidence in their financial performance, and their outlook also has an expectation of steady year-over-year revenue with a parcel volume growth of 15%. And just like our previous stock, ZTO also has 7 unanimous buy ratings. And the average price target comes in at $29.71 for an upside potential of 40%. Looking at our ratings down below, we don't have any drastic low-end price targets. We have one buy rating back in March with an upside of 15%, and our high-end price target has an upside of nearly 82%. So that is a quick look at 3 under-the-radar growth stocks, all coming in with a strong buy consensus from Wall Street analysts. Let me know your thoughts on these 3 companies in the comments down below. I always love hearing from you guys. And of course, please keep in mind these videos are never a suggestion to buy or sell any specific stock. Please make sure you always do your own due diligence and research. If you made it to the end, don't forget to hit that thumbs up button. Thank you guys so much for watching. Have a great day, and I'll see you back here next time.